Welcome to Your Key to Diversified Investing, where we unlock the power of a well-balanced portfolio. Let's embark on a journey to understand the art of spreading your investment eggs across multiple baskets. Diversified investing, at its core, is a risk management strategy. It's the idea of spreading your investments across various asset classes, such as stocks, bonds, real estate, commodities, and even cash. But why, you may ask? Should we not put all our money into that one promising stock or that booming real estate project? The answer is simple: risk. Investing all your resources into a single asset class is like betting all your money on a single number in a game of roulette. Yes, you might hit the jackpot, but more often than not, you stand a chance to lose it all. Diversified investing, in contrast, is like spreading your chips across the table. You might not win big on a single bet, but you're likely to walk away with something. Risk reduction is one of the key benefits of diversified investing. By spreading your investments, you reduce the impact of any single asset performing poorly. In other words, if one of your investments takes a hit, the others can help cushion the blow. But it's not just about playing safe. Diversified investing can also lead to potentially higher returns. When one asset class is underperforming, another might be flourishing. By having a finger in every pie, you increase your chances of being part of the winning game. Think of it as a symphony. Each instrument plays a different part, but they all come together to create beautiful music. Similarly, diversified investing brings together various assets to create a robust and resilient portfolio. So whether you're a seasoned investor or someone just starting out, diversified investing can be a versatile and powerful tool in your financial arsenal. Stay tuned as we delve deeper into the pillars of diversified investing. Understanding the basics of diversification is the first step towards a well-rounded investment strategy. So let's dive into what it's all about. Diversification, in the simplest terms, is the strategy of spreading your investments across various asset classes, sectors, and geographical regions. It's essentially the financial embodiment of the age-old wisdom: don't put all your eggs in one basket. This strategy is primarily used to manage risk. Imagine investing all your money into a single company. If that company were to unexpectedly go under, your entire investment would be wiped out. But if your investments are spread across multiple companies, industries, or even countries, the impact of any one company's failure would be significantly less. Now, there are several types of diversification you can consider. First, there's diversification across asset classes. This means dividing your investments among different types of assets such as stocks, bonds, real estate, and commodities. Each asset class tends to perform differently under various market conditions, so a mix of these can help smooth out the bumps along your investment journey. Next, we have industry diversification. This involves spreading your investments across different sectors or industries, like technology, healthcare, finance, and more. Each industry has its own set of risks and opportunities, so investing in a variety of industries can help insulate your portfolio from the ups and downs of any single sector. Then there's geographical diversification. This means investing in different regions or countries. Different economies may perform differently at different times due to a multitude of factors like political stability, economic policies, and currency strength, among others. Hence, geographical diversification can provide an additional layer of protection against regional economic downturns. However, it's important to remember that diversification is not about just randomly spreading your investments. It's a strategic decision that requires a good understanding of your investment goals, risk tolerance, and time horizon. It's about finding the right balance that aligns with your financial objectives and comfort level with risk. One common misconception about diversification is that it guarantees profits or completely eliminates risk. That's not the case. What diversification does is help manage and mitigate risk. It's like a safety net that can cushion the fall if things go awry, but it doesn't prevent the fall itself. Also, diversification is not a one-time task. It's an ongoing process that requires regular review and adjustment as market conditions change and as your personal financial situation evolves. It's a dynamic strategy that needs to adapt and evolve with time. Now that you've grasped the basics, we'll explore how to implement diversification in your investment portfolio. Remember, diversification is not about achieving perfection. It's about managing risk and striving for consistent long-term returns. So keep an open mind, stay informed, and make balanced, well-considered decisions. After all, the journey of investing is not a sprint, but a marathon. Implementing diversification may seem complex, but with the right approach, it can be straightforward. Diversifying your portfolio is akin to creating a well-balanced meal. You wouldn't want to fill your plate with just one type of food, right? You'd probably want a little bit of everything to ensure you're getting a variety of nutrients. Similarly, in investing, you don't want to put all your money in one type of investment. You want a mix of different investments to balance out the risks and enhance potential returns. So how do you go about diversifying your investment portfolio? The first step is asset allocation. This involves dividing your investments among different asset classes, such as stocks, bonds, and cash. The right mix for you will depend on your financial goals, risk tolerance, and investment horizon. For instance, if you're a young investor with a high risk tolerance and a long-term investment horizon, you might have a higher percentage of stocks in your portfolio. On the other hand, if you're nearing retirement and prefer stability, you might lean more towards bonds. Once you've decided on your asset allocation, the next step is to diversify within each asset class. This means investing in a variety of sectors and industries. Let's take stocks, for example. Instead of investing all your money in technology stocks, you might want to spread your investments across different sectors like healthcare, finance, energy, and consumer goods. This way, if one sector performs poorly, the other sectors might perform well and balance out your returns. But diversification doesn't stop at sectors. You should also consider geographic diversification. This involves investing in different regions around the world. By doing so, you can take advantage of growth opportunities in emerging markets and reduce the risk associated with investing in a single country or region. Now you might be wondering, how do I keep track of all these investments? This is where rebalancing comes into play. Rebalancing is the process of realigning the weightings of your portfolio. Over time, some investments may perform better than others, causing your portfolio to drift from its original asset allocation. By rebalancing, you can ensure your portfolio stays aligned with your investment strategy. Rebalancing is typically done on a regular basis, like annually or semi-annually, or when the weightings of your investments shift significantly. For instance, if your original asset allocation was 60% stocks and 40% bonds, but due to strong stock market performance, your stocks now make up 70% of your portfolio, it might be time to rebalance. You could do this by selling some stocks and buying more bonds to bring your portfolio back to its original 60-40 allocation. One final note on diversification. It's not a one-size-fits-all strategy. What works for one investor might not work for another. It's important to tailor your diversification strategy to your individual needs and circumstances. And remember, diversification can help manage risk, but it can't eliminate it completely. So, always make sure you're comfortable with the level of risk in your portfolio. Having a diversified portfolio is only half the battle. Monitoring and adjusting your portfolio is the key to maintaining diversification. A robust diversification strategy requires regular monitoring and adjustments. This is a truth that cannot be overstated. Having established a diversified portfolio is just the first step in a journey that requires constant vigilance and fine-tuning. So why is monitoring essential? Simply put, the market is ever-changing. The values of your investments fluctuate, sectors rise and fall, and new opportunities continually emerge. The balance you initially created can quickly become distorted if left unchecked. Consider this. Imagine you've spread your investments across 3 sectors: technology, healthcare, and manufacturing. Initially, each sector makes up 1/3 of your portfolio. However, in a year's time, the technology sector experiences significant growth. Suddenly, it constitutes half of your portfolio. This might sound like a good thing, but remember, with increased exposure comes increased risk. If the technology sector takes a sudden downturn, your portfolio will feel the impact significantly. This is where portfolio rebalancing comes into play. Rebalancing is the process of realigning the weightings of your portfolio. It involves periodically buying or selling assets to maintain your original or desired level of asset allocation or risk. How often should you rebalance? Well, there's no one-size-fits-all answer. It depends on various factors like your risk tolerance, investment goals, and the nature of your investments. Some investors prefer to rebalance on a set schedule, such as quarterly or annually. Others choose to rebalance when their asset allocation deviates by a certain percentage from their target. For instance, if you've decided that stocks should make up 60% of your portfolio, you might choose to rebalance if stocks rise to 70% or drop to 50%. It's essential to have a clear rebalancing strategy in place and stick to it. Remember, rebalancing is not about chasing returns, but about sticking to your strategy and managing risk. Rebalancing does come with potential costs, including transaction fees and potential tax implications. So, it's essential to consider these factors when deciding how often to rebalance. Now, how do you rebalance? There are two common methods: the calendar method and the threshold method. The calendar method involves rebalancing at regular intervals, say every 6 months or a year. The threshold method, on the other hand, involves rebalancing whenever an asset's weight in the portfolio deviates by a predetermined percentage from the target. Sometimes you might need to do more than just rebalance. Market conditions or changes in your personal circumstances might necessitate a review of your diversification strategy itself. For instance, nearing retirement might mean you want to shift to more conservative investments, or a booming new sector might present opportunities you want to exploit. In essence, monitoring and adjusting your portfolio is about staying agile. It's about understanding that diversification is not a set-it-and-forget-it strategy, but a dynamic process that requires your active involvement. Remember, the goal of diversification isn't to maximize returns, but to limit risk. It's about achieving a balance that allows you to weather the storms of the market while still making steady progress towards your financial goals. And here's a final word of caution. While it's essential to be active in managing your portfolio, beware of overdoing it. Constant tinkering can lead to overtrading, which can eat into your returns through transaction costs. So, monitor, adjust, but also be patient. Investing is a long-term game. Now, let's move on to some common misconceptions about diversified investing. Diversification is often misunderstood. Let's clear up some common myths. Myth number 1. Diversification guarantees profits. If only this were true, investing would be a breeze. But in reality, diversification is a strategy to manage risk, not a magic wand that turns every investment into gold. In the world of investing, there's no such thing as a sure thing. Diversification can help spread your risk across different assets, but it doesn't eliminate the risk altogether. You can still lose money. Now, on to myth number 2. Diversification is only for risk-averse investors. This is a misconception that can prevent many from reaping the benefits of a diversified portfolio. Whether you're a risk taker or more on the conservative side, diversification should be an integral part of your investment strategy. Even the most adventurous investors need to balance their portfolio to manage potential losses. It's like a safety net. Even if you love the thrill of the high wire, wouldn't you still want a net underneath? Third myth, and a prevalent one at that: more diversification is always better. Not necessarily. Over-diversification can actually be counterproductive. If you're invested in too many different assets, it can be difficult to keep track of everything. You may also end up diluting your potential gains. Think of it this way: if you're trying to listen to 100 different songs at once, you're not going to enjoy the music. The same goes for your portfolio. Too much diversification can create a cacophony rather than a symphony. Myth number 4. Diversification means investing in different stocks. This is partially true, but it's only a slice of the diversification pie. True diversification means spreading your investments across different asset classes, not just different stocks, but also bonds, commodities, real estate, and potentially even alternative investments like cryptocurrencies or art. Think bigger, think broader. Finally, myth number 5. Diversification is a set-and-forget strategy. If you think you can simply diversify your portfolio and then ignore it for the next 10 years, you're in for a rude awakening. The financial markets are dynamic and constantly changing. What was a balanced portfolio a year ago may not be balanced today. Diversification isn't a one-time act, it's a process. It requires regular review and adjustment to keep your portfolio in line with your investment goals. Diversification is not a panacea, but it's a vital tool in your investment toolkit. It doesn't guarantee profits, and it's not just for the risk-averse. It isn't about owning a bit of everything, and it's more than just investing in different stocks, and it certainly isn't a set-and-forget strategy. The truth is, diversification is about balance. It's about spreading your investments across different asset classes to manage risk. It's about finding the right mix for your individual investment goals and risk tolerance. And it's about regularly reviewing and adjusting your portfolio to keep it aligned with those goals. With these myths debunked, let's explore some examples of diversified investing in action. Theory is good, but seeing diversified investing in action is even better. Let's dive into some real-world examples of successful diversified investing. These stories will highlight how astute investors have navigated choppy market waters with the help of a well-diversified portfolio. First up, we have the tale of a savvy investor named Julia. Julia began her investment journey in the early 90s. She understood the power of diversification and put it to work by allocating her funds across a wide range of asset classes. She invested in stocks, bonds, real estate, and even ventured into emerging markets. Over the years, her portfolio weathered several market downturns and economic crises. But thanks to her diversified approach, she was able to mitigate her losses and continue growing her wealth. Next, we have the story of a retirement fund. This fund was set up to provide for the retirement of several thousand employees. The fund managers, understanding the importance of diversification, spread the fund's investments across a variety of sectors and asset classes. They invested in technology and healthcare stocks, government and corporate bonds, and real estate investment trusts. When the dot-com bubble burst in the early 2000s, the fund's tech stocks took a hit. However, the other investments cushioned the blow, and the fund continued to grow. Then we have the case of a global investment firm. This firm managed billions of dollars and had clients from all walks of life. To protect their clients' wealth and generate steady returns, the firm adopted a diversified investment strategy. They spread their investments across different geographies, sectors, and asset classes. This strategy paid off during the financial crisis of 2008. While many firms faced severe losses, this firm's diversified portfolio helped them navigate the crisis relatively unscathed. Finally, let's talk about an individual investor, Sam. Sam was new to investing and had a limited amount of money to invest. He decided to diversify by investing in a low-cost index fund, which is a type of mutual fund that aims to replicate the performance of a specific market index. This allowed him to spread his investment across hundreds of different companies with just a single purchase. When the pandemic hit in 2020, many individual stocks plummeted, but Sam's index fund, thanks to its diversified nature, was able to weather the storm. These real-world examples underscore the power of diversified investing. Each case illustrates how spreading investments across different asset classes, sectors, and geographies can help mitigate risk and navigate market volatility. Diversification doesn't guarantee profits or protect against all losses, but it does provide a level of security that single asset investing simply can't offer. It's important to note that diversification isn't a one-size-fits-all strategy. The right mix of investments will depend on a variety of factors, including your financial goals, risk tolerance, and investment horizon. But as these examples show, a diversified investment strategy can serve as a robust foundation for building and preserving wealth. So whether you're a seasoned investor like Julia, managing a large fund, running an investment firm, or just starting out like Sam, diversified investing can play a crucial role in your investment journey. It's not about chasing the highest returns or finding the next big thing. It's about creating a balanced portfolio that can withstand market ups and downs and steadily grow your wealth over time. Now that we've seen diversified investing in action, let's recap what we've learned. Let's recap the journey we've taken to understand diversified investing. In our expedition, we've embarked on the path to financial wisdom, taking a deep dive into the art of diversified investing. We've unraveled its fundamentals, explored its implementation, and understood its constant need for monitoring and adjustment. We've also debunked some myths along the way and illustrated the concept with real-world examples. At the outset, we introduced the concept of diversified investing, the strategic allocation of resources across a variety of investments to reduce risk and increase the potential for returns. It's not about putting all your eggs in one basket, but rather spreading them across multiple to cushion the impact should one fall. We then delved into the basics of diversification, highlighting its core premise: risk management. Diversification is not about chasing the highest returns, but about creating a balanced portfolio that can withstand market fluctuations. We have emphasized that the key is to distribute investments across different asset classes, sectors, and geographic regions to achieve a balance between risk and reward. Our journey continued onto the practical application of diversification. We explained how to create a diversified portfolio, starting from understanding your risk tolerance and financial goals, to selecting the right mix of investments. It's not a one-size-fits-all approach, but a tailored strategy that aligns with your unique financial situation and aspirations. We then moved on to the crucial aspect of monitoring and adjusting your portfolio. Diversified investing is not a set-it-and-forget-it strategy. It requires regular monitoring and rebalancing to ensure it stays aligned with your financial goals. Market changes, life events, or shifts in your risk tolerance can all necessitate adjustments. Midway, we stopped to debunk some myths about diversified investing. Contrary to popular belief, diversification is not just for the risk-averse or the wealthy. It's a sensible strategy for all investors, regardless of their financial standing. It's also not about owning countless stocks and bonds. The goal is not quantity, but quality and balance. Our exploration then took us to real-world examples of diversified investing. We showcased how a well-diversified portfolio could weather the storms of market downturns and still sail smoothly towards its financial goals. These examples served as tangible proof of the power of diversification, reinforcing its relevance and necessity in the world of investing. As we conclude, remember that diversified investing is not a magic bullet. It doesn't guarantee profits or shield against all losses, but it does provide a framework for managing risk and potentially enhancing returns over the long term. It's a tool, a key if you will, that can unlock the power of a well-balanced portfolio. So as you venture into your investing journey, keep the lessons from our exploration in mind. Embrace the art of diversification, understand its principles, implement it wisely, monitor and adjust your portfolio regularly, and debunk any myths that come your way. Remember, diversified investing is your key to unlocking the power of a well-balanced portfolio. Thank you for joining us in this journey.